In this example video, we're going to look at review exercise 13-9. So it tells us that on February 1st, the Razorback Corporation decides to transfer its available for sale securities to the trading category. These securities had been purchased for $9,400 in early 2018 and had a fair value of $11,700 as of December 31st, 2018. And on February 1st, 2019, the securities have a fair value of $12,500. So they want us to prepare the journal entries to record the transfer. So we're transferring it from one classification of investments to another. So on February 1st, we have our investments in trading securities. We need to increase because we are now going to have those be investments in our trading securities rather than available for sale. They tell us that on that date that we're doing the transfer, those investments are worth $12,500. We need to remove off of our books our investment in our available for sale securities. They told us that we purchased those investments for $9,400 in 2018. Remember, with available for sale securities, we record them at what we pay for them, and we don't actually directly impact that investment account when we do the change in that value. We have the allowance account that either is going to be an adjunct account or a contra account each period, depending on if at our balance sheet date the fair market value is higher or lower than what our carrying value is for that investment. So in this case, we're going to take them off for the value that we purchased them back in 2018 for $9,400. So the difference between the two is a gain on the transfer of our securities. We've actually gained some value that we get to record because they're now considered trading securities, and we're reevaluating those investments at that date. We also have to reverse the effect that the investments in our available for sale securities had on that unrealized account and that allowance account that we had. So on February 1st, we need to reverse the impact. They told us that as of December 31st, the fair value of those investments were $11,700. And again, we had purchased them for $9,400. So we need to reverse that impact overall between the two. So it was actually an unrealized gain as of December 31st, 2019, because our fair value was higher than the price that we had originally paid for it. So our unrealized gain goes on as a credit. So in order to reverse the impact, we are going to debit the unrealized holding gain or loss on our available for sale securities. And that means that at December 31st, we would have wanted our allowance account to be an adjunct asset account, meaning it would have been adding to the value of our investments because our fair value was higher than the price we had paid for those investments. So again, in order to reverse the impact, we are going to credit our allowance for change in our fair value of our investment. And it's going to be for the difference between the two. So $2,300 is the difference between what our fair value was at December 31st at $11,700 and how much our investment was worth when we purchased it at $9,400.